Okay, our second example is going to have to do with some sort of import quota or even some sort of tariff that is designed to help alleviate the trade deficit. You know, people see a trade deficit, they get very concerned. We certainly have seen some presidential candidates who rail against the trade deficit. They call it losing. I obviously think there are gains from trade, so I don't agree with that characterization. But let's say we have this big trade deficit and we want to try to do something about it. And one of the solutions that's proposed is some sort of quota or tariff. So, on some of the goods that are being sold in this country that are being produced abroad. Well, so this is the market. So remember, this is the market for loanable funds, determined by savings and investment, setting the real interest rate. The real interest rate determines the amount of net capital outflow, and then net capital outflow and net exports end up determining the real exchange rate. So let's say we put on a quota or a tariff that reduces the amount of imports of a particular good into the United States. And so what's the effect of that going to be? Well, the short-term effect of that is going to be reduce the amount of net. It's going to try to increase net exports. But what's going to happen is if we decrease the amount of imports, there's less dollars demanded. So the demand for dollars is going to fall at any given exchange rate. But remember that net exports has to equal net capital outflow. So what the effect is going to be, we're going to end up increasing the value of the dollar in foreign exchange markets, because what's going to happen is with fewer dollars going overseas to purchase these imported goods, because imports have fallen, there's less supply, in a sense, of dollars into the foreign exchange market. A reduction in supply, as we know, is going to lead to a higher price. So the value of the dollar is going to go up. Because the value of the dollar goes up, goods here in the U.S. are suddenly are more expensive, and so the amount of purchases of U.S. goods and services from foreigners is also going to go down, right? Demand curves slope down. So if you increase the price of goods in the U.S. through an increase in the exchange rate, we're going to see a reduction in the amount of purchases of goods and services here in the U.S. So we have decreased the amount of imports because of the quota or the tariff, but we've also decreased the amount of exports due to the increase in the value of the dollar, making goods and services here in the U.S. more expensive. And so a quota or a tariff can certainly help one particular industry. So if we put a tariff on automobiles, it would help domestic automobile manufacturers. If we put a quota on automobiles, which has been done in the past, it would help domestic automobile manufacturers. But the total impact on the trade deficit would be nothing. There would be an offsetting change in the value of the dollar that would decrease the amount of exports, and so net exports remain unchanged because, as we know, net exports has to equal net capital outflow, and net capital outflow is a function of the real interest rate, which has to do with our savings and has to do with investment opportunities here in the United States. So if you're really concerned about the trade deficit, the solution is not to necessarily put a quota or a tariff on imports, but is to do something about savings. If you think about it, a trade deficit by definition means that we're consuming more than we're producing. Right, because GDP is consumption plus investment plus government spending on goods and services plus net exports. And if net exports is negative, it means our consumption, our investment, and our government spending on goods and services is greater than the amount that we're producing, because the amount we're producing, of course, is brought down by this negative number of net exports. So if we really want to change our trade deficit, the solution is not a quota or a tariff, but is to do something about our savings, to increase savings which means either some sort of reduction in consumption, maybe government purchase of goods and services, or personal consumption by raising taxes. If you raise taxes on people, they'll have less money to spend. I mean, and the government budget deficit will decrease. I'm not saying that's what should happen. I'm saying that is the solution if you believe that the trade deficit is a problem. Which I'm agnostic about that question, whether it's trade deficit is a problem or not. The final example we're going to talk about is the question of capital flight. Sometimes you'll see a country, maybe because of political instability or some sort of turmoil within the country, maybe even a war breaks out, a coup occurs, something happens, and a lot of investors or people just try to get their money out of the country. And so we call that capital flight, when you see money, people trying to get their money out of a country. So what happens is there's net capital outflow increases. So for any given interest rate, people want to get their money out of the country. And so you see an increase, a shift in this curve, in the demand curve for net capital outflow. And it's not the investment part, it's the net capital outflow that really increases as people are trying to get their money out of the country. Now, while the real interest rate is certainly a determinant of net capital outflow, one of the other things on the list, of course, is the political stability within a country. So what we're going to see is that this curve is also going to shift out. For any given interest rate, there's going to be more net capital outflow. And so this, of course, is going to increase net capital outflow for any particular exchange rate. And so for the country that is experiencing capital flight, the exchange rate is going to fall. And so this is obviously a really bad situation for a country to be in, because they're having to deal with higher interest rates and a lower exchange rate at the same time. So a higher interest rate, of course, is going to, and we'll learn more about this later on this week, higher interest rate is going to have the effect of decreasing economic growth, economic activity, and a lower exchange rate is basically a lower standard of living. So what the currency that you have and your ability to purchase foreign goods and services decreases even as you're experiencing high interest rates. So this is a very, very terrible situation that unfortunately we have seen many times in history, and even today we're seeing some countries that are experiencing capital flight. And this is the effect: higher interest rates and a lower real exchange rate. All right, so that's the little recap of these two chapters, and look forward to seeing you in class. You can call me or text me or send me an email if you have any questions. All right, bye-bye.